Well, this is a high-level view of what we'll be doing this week, and they are identified by the chapter markers in the video. We'll start with a discussion of our par yields, real yields, and break-even rates, and something interesting to see here. Then we'll do a little bit of a deeper dive in housing. We'll look at retail sales, and we'll try to calculate what a real growth rate in retail sales were. Then we'll carry that information over to Walmart and Target and see if it is consistent with what we saw in retail sales and consistent what we saw in Q1 GDP. Don't miss this, interesting stuff there. We'll move over to the index, look at levels on the index, and I'll present an options trade. We'll look at the Canadian dollar and introduce a trade there using futures contracts. Then we'll look at USO and UGA. One is oil, one is gas, and we'll look at some bull spreads on that. And then we'll end by looking at the risk ahead, the week, the economic calendar ahead, and what risks we have to face. Start with our yields, as we always do. Same story as we had last week. Drop in rates, 2-year out to the 30-year. I have the total 2-week change in rates down here, with the 2-year dropping 12 basis points, the 10-year dropping 34 basis points over the last 2 weeks. So 2 out to the 30. For the last 10 years, we had a situation where bonds went up, stocks went up. And for the first, 4.5 months of this year, stocks went down, bonds went down. For the last 2 weeks, stocks went down, bonds went up. There's that negative correlation that we were told back in university when we talked about a 60-40 portfolio, that our bonds would move counter to what our equities do to provide lower portfolio volatility. Well, that's just shown up in the last 2 weeks. Think that's going to stick around? I don't know, because we have a 50 basis point increase that everyone is expecting, and I think you could put 100% weighting on that. We have that happening June 15th. 2 days in front of options expiration, which is June 17th. So I think you'll have a lot of premium in those options that aren't going to leave until Wednesday afternoon. So we're expecting 50 basis points. That'll take us to 1.25 to 1.5 on the overnight, which will push up your front end of the curve. What's going to happen to the back end of the curve? That'll be interesting to see. I don't know that that we can continue to expect this to happen, but for the last 2 weeks it has. If you think that, well, that's just, bonds were oversold. If you had watched TLT, the ETF, it had gone from 161 at the beginning of the year down to 111. Over 30% drop, 33% drop in 4 months. At the beginning of the year, at the end of last year, I suggested, when TLT was at about 160, selling a $135 call for the whole year, figuring that over the year the bonds will drift down to below 135. That happened almost immediately and kept going to 111. I never would have anticipated that they would have moved that fast. So the last 2 weeks has been probably a recognition that, with positive real yields, these are looking interesting to move into. So we'll look at real yields on the next screen. Our yield curve in between here, I call it flat-ish. If you look at yields from the 3-year out to the 10-year, 273, 280, 282, 278, it's kind of flat-ish. And for 2 weeks in a row, the curve has flattened out. The 2s to 10s are now at 18. They went from 40 down to 18, so you have a drop of 22 basis points over a 2-week period on the 2 to 10 year. Let's look at our real rates, our break-even rates. There's a little kind of a neat, interesting story there, and then we'll look at mortgage rates and dive on the housing market. So here are our real yields. We're still positive from the 7 out to the 30, and we're getting a little bit more positive on the 5. This over here, you can call that unchanged. In fact, I would even say, given the volatility for the week, these things are sort of just unchanged, but they're still real. This is what's interesting. Here is the break-even rates from the 5-year out to, well, we'll cut it off there. There's the 30-year. This is the 5-year forward. And these are our break-even rates. Look at the beginning of the year, January, at the very beginning of the year, before a lot of this loud talk showed up about rates and inflation. It was just sort of some rumblings that something's going to have to be done about this. Well, look where we are now, all lower than on January 3rd, except the 10-year. We're just only 7 basis points higher. You can pretty much call that almost unchanged. But all the break-even rates are lower on as of the close of May 20th than they were on January 1st. And if we look at the 5-year forward, which should remove, if we expect inflation to get under control in the next 6 months to 12 months to a year, the 5-year forward would have it completely removed. 222 versus 225 at the beginning of the year. At the beginning of the year, January 3rd, for the first week, we still had a very strong market. We were still, I think we hit new highs early in January before it really started to turn negative. So this was before everything started turning negative, and our inflation expectations, that is built into the break-even rate, is lower than it was at the beginning of the year. Now this could be, well, nominal yields are lower. Bonds did rally, but not on the tips. The real rates are still, where they were, if not a little bit higher. Maybe it's just an oversold condition, and this is a mathematical result of the two rates. Maybe there's no information in there, as opposed to, well, this is, let's say that it's intentional. I just find it very interesting that as of May 20th, especially with rates, the talk of rates going higher, the talk of inflation going higher, that our break-evens are actually lower now than they were at the beginning of the year, especially this 5-year forward. Let's look at the housing market. And if we look at the housing data on the surface, we would think that it doesn't look very good. But as we dive a little bit deeper, we start to see, or maybe sort of piece together the idea that, well, let's say that last year I sold 100 of something that I made. And this year I only sold 75, only because I could make 75 and that was it. I couldn't sell 100. I could only make 75, but I sold them all. Sales are down 25%, sure, but that's not because there was a lack of demand. It was just there was a lack of supply. So we're going to look into the supply side and see what's going on. Here are the mortgage rates as of Friday. The 30-year fixed was 5.35. The week before was 5.38, basically unchanged. The adjustable rate mortgage, the one is 4.52. Last week it was 4.6. And we had a bunch of housing data over the week. The new house price index year over year for April was 9.4%. Interesting, month over month was 0.3. If you annualize that, that's 3.66% annualized. Is 9.4, which is rather muted considering the house pricing gains we've had over the last few years. 9.4 is starting to drift downward. Still 9.4% higher month over month, but annualized, year over year, month over month, annualized 3.66. Building permits month over month down 3.2%. That's for the month of April. Housing starts month over month down 0.2% for the month of April. And we've already talked about home builders last week having tighter credit conditions, finding it harder to get credit. This pullback in housing starts, as we will see, is not really a function of the willingness to build, but of the ability to build. Mortgage applications, there's no good spin on this, down 11%. The refi index we would expect to be down, and it's down 9.05% week over week, down 76% year over year, and that would make sense because mortgage rates are up about 200 basis points year over year. You're not refinancing at a mortgage rate that's 200 basis points higher than what you have. That makes a lot of sense. But our purchase index dropped almost 12% It's down 15% year over year. Let's put the percent sign in there so we know we're talking 15%. Down 15% year over year. Existing home sales in April, month over month, were down 2.4%. So if we look at Realtor.com here, median listing prices, this is a week ending May 14th, and this is year over year change. Median listing prices on Realtor.com are up 15.9%. New listings are higher. They're up 0.6%, and active listings are up 5% over last year. So the number of listings available on the site are 5% higher than they were last year, which is good. However, they are selling 6 days faster than they were last year. That still indicates a tight market. Prices up 16%, even though you have listings that are up over last year. Active listings and new listings coming on, they're still selling faster. So when we look at the purchase index being down 12%, existing home sales negative 2.4%, housing starts down 0.2%, the increase in the housing pricing, we're seeing that prices are well supported, but volumes are down. But they're not taking longer to sell. They're still, this was the same last week. Year over year was 6 days faster. It's still 6 days faster. It's not like it's gone to 4 days faster and then 3 days faster. It's still 6 days faster. On this screen, I'm going to highlight the main points of an interview that was done with the CEO of GTIS Partners. And they do a lot in the real estate sector. I think they have like $3.4 billion in real estate assets. They're involved in home building, land development, and infill acquisition and development. And this is taking a site that has something on it that is no longer in use, like an old hospital or something, and it's been abandoned. Not so much abandoned, but it's no longer in use. It's been boarded up, and they'll take that and redevelop it into something else. They report over the year sales are down 15 to 20%. And you would think, well, that's what high prices and high mortgage rates do, is they will drop the demand for housing. So we look at sales being down 15 to 20%. We look at existing home sales being down 2.4%. Housing starts down 0.2%. And we think, well, this is signs of demand destruction. Well, let's just go a little bit further. They still have a wait list. Even though sales are down 15 to 20%, they still have a wait list. Well, if they're waiting for a home, how are sales down, right? They are selling every home they can deliver. They have less than 2 months supply. And when we listen to the auto companies' first quarter reports, GM, Ford, Tesla, they all said the same thing. They don't have a demand problem. They have a supply problem. They can deliver, they can sell every single vehicle they make, which is what they're doing, selling every vehicle they make. They simply don't have an inventory of finished goods. And same thing we're seeing here. They don't have an inventory of finished goods, less than 2 months supply. What they are saying is that supply is still a significant problem. Issues in transportation, that is getting materials to the site, issues in finding labor, and in actually sourcing materials, especially windows. And they relate, anecdotally, I think I'm saying that right, a development that they finished where they couldn't get the windows, so they delivered the houses with plywood windows. Just boarded up, saying as soon as the windows come in, we'll get them to you, but there's no point in you waiting any longer for your home. We don't know when the windows are going to come in. And I can attest to that. Last year, I ordered a patio door, a 3-pane door, not the 2, but the 3. And you do have to order that. It doesn't take very long. But after 4 months, the supplier of the windows canceled it to the contractor, saying there's no point. There is no supply on the horizon. There's no point. So then it was canceled to me, and what I paid was refunded for that. But you couldn't get it. I'd probably still be waiting now a year later for those windows. You can't get them. So, they're being held back by supply issues. They have a drop in sales, and they say they're very clear about it. Our drop in sales is not a demand issue. We are selling every home that we can build, and we have a wait list. Sales are down due to supply being down. And they do note that other home builders are holding back as well. Partly because, as we reported last week, that there is a contraction in credit available for home builders. They're finding it harder to get financed for development. So, why pay the higher costs to get it done? And if there's going to be a credit shortage, oh well, there'll be a housing shortage. They're holding back because they have a couple of issues, as he mentioned. They don't know what to sell the house for, because they don't know what their labor cost overruns are going to be. They don't know what their material cost overruns are going to be, and pricing is changing so rapidly on some supplies and availability, they just don't know. So they're holding back on building big developments for spec and rather just selling for sale. And they do note in selling for sale that their buyers are not really slowing down in their willingness to buy, but they are just managing the price by taking fewer features, fewer upgrades, and going for a smaller footprint. So the question was asked, I should note here, they did note traffic is down. So it is having some effect on new demand coming in. The traffic is down, however, they still can sell every home they build, but they are noticing that there are fewer people coming through their developments, which you would expect, right? The question was asked, like 2008, you had a big housing market crash because prices had just gone way past what was sustainable at that time, and we're seeing the same thing. Are we in for the same problem? And it was a nice contrast. In 2008, he notes the household formation was 1.2 million and new housing supply was coming in at 2 million. Well, it doesn't take long at that rate to get an oversupply, and it also coincided with demand crashing. So you had a massive oversupply with demand crashing. Prices are going to come down. Today, however, household formation is greater than new housing supply. So here, the new housing supply was greater than household formation today, and I think for the last 10 years now, household formation has outpaced new housing supply. So we're going to look at a bunch of interesting charts from Realtor.com to put this in a visual perspective. This is on Realtor.com. This was posted September 9th, 2021. It's 9 months old, but the trends that we're looking at here don't reverse in 2 or 3 quarters. They take years to reverse. So it is worth looking at the state of affairs at that time. And the first couple of bullet points are important, then we'll look at a chart. In 2020 and the first half of 2021, the U.S. saw 2.1 million household formations, resulting in 12.3 million household formations between 2012 and June 2021. This is a killer here. In this time period, 7.5 million single-family homes were started, 7 million single-family homes were completed. 12.3 million household formations met with 7 million single-family homes. The gap between single-family home construction and household formation grew from 3.48 million homes at the beginning of 2019 to 5.24 million homes as of June 2021. At the 5-year average rate of home completion and household formation, the gap would only widen. Assuming household formations continue at the current 5-year average, the average rate of home completion would have to triple to close the gap in home completions and household formations in 5 to 6 years. So to close that gap in the next 5 to 6 years, assuming household formation continues to grow at the same rate it has over the last 5 years, you would have to triple the amount of completions from where they are now. Look at this chart here. This is the cumulative shortage of new home supply since 2012. And here's the zero line, and this indicates a surplus, and it's just gone pretty much straight down. I don't know that any part of this had increased, and it's only a slight increase that we're seeing here, but not much. This is a negative 5.5 million here. This is negative 5 million. So you're just under a little deeper than 5 million in terms of the shortage. But that's a powerful statement when you put it in that way, that even if you triple home completions now, family household formation is still going to continue to grow. You got to work off this gap while meeting increased demand every single year for new household formation. So that's incredible. This here is vacancy rates. This speaks to supply as well. Look how low this is, homeowner vacancy rates. This is yearly household formation versus housing starts. You can see the red line is the housing household formation. This line here is housing starts. You can see all the area under the curve up to the black line is supply that simply just didn't exist. At the time of the writing, it looks like it was starting to improve, but you know, you're not going to turn this around in 2 to 3 quarters. And we have not seen home completions in the last 3 quarters triple on an annual rate basis. So we are nowhere near, this is saying in 5 to 6 years, we are nowhere near having it completed during that period of time. It's not just the US. Canada has a housing shortage as well, a massive housing shortage. That you need significantly more homes built to keep pace with household formation. So it's raising rates isn't going to solve this particular problem because it is a supply issue. That's why I've said in previous updates that my biggest concern for markets is a policy mistake. Is the central bank hammering away on interest rates, trying to get inflation down when some parts of inflation are not really demand driven but primarily supply driven. If I can't find any better evidence of supply driven housing pricing than what we're seeing here, that you have demand growing at a certain rate and supply growing at a rate significantly less, and you end up with this huge deficit that even if you tripled supply at this point going forward, it would still take 5 to 6 years to work all this off. Let's move on to retail sales. This is a report we had last week. Retail sales was actually quite good. 8.2% year over year. 8.2%. The March PCE was 6.6%. This was headline. We'll compare the 8.2 with the 6.6 if we, this is for April, this is for March. We haven't had April's PCE yet. We'll get that on May 27th, but when we get it, you would substitute that into the denominator to get the percentage change in real growth in retail sales. But if we take 8.2% year over year, and we control for inflation using the PCE, not the CPI. We don't use the CPI for this one, we use the PCE. You have a real increase of 1.5%. 6.2% year over year if the PCE comes in at 6.2% instead of 6.6 for March, but drops. That would mean that April retail sales had a real growth rate of 1.89%. You'll recall Q1, the consumer made up 1.83% for Q1 GDP. C equals 1.83%. We had negative GDP for Q1 because imports crushed. And we'll talk about imports when we put Target and Walmart into perspective. We'll look at does the evidence from Q1 support what they're saying, and it aligns up very nicely. But this is consistent with Q1 growth in consumer consumption. Why do we use the PCE and not CPI? The CPI measures change in the price level regardless of sales, whereas the PCE measures the change in price based on what is actually purchased. So I'll give you an example of why it matters for retail sales, why you would use PCE on retail sales and not CPI. The CPI prices out a fixed basket of goods every month. So let's say it calls a restaurant and prices out a steak dinner in month T. And they say that steak dinner is $39. The CPI does have a, they do measure the price for a category called food out. In other words, in restaurants. Next month, they call that restaurant, they say, how much is that steak dinner? And they say $40. And they say, aha, there is evidence of inflation. But what if nobody bought it? Sure, the price is higher, but if nobody bought it, nobody actually experienced this inflation because nobody bought it. If you ask them, well, how many units did you sell? And if they say, well, we sold 0 units of it. Well, if you sold 0 units, that's nobody's inflation. Nobody paid that price. Nobody experienced it. And if you sold 0 units, it would not show up in retail sales. The PCE measures prices based on what is actually purchased. So it is the change in the prices of the stuff that actually gets purchased as opposed to the change in the prices of some fixed basket, whether or not they get purchased. So since retail sales is what is actually purchased, you would deflate retail sales by the PCE inflation measure, not the CPI inflation measure. And when we use March's 6.6, we have 1.5% real growth. And again, we get the new PCE on Friday. If it comes in lower, I just use an example here. If it comes in at 6.2, that number only looks better. So everything lower than 6.6 just makes retail sales for April look better and better and better. But if it comes in higher, well then yeah, then it's going to make things look worse and worse and worse. Let's look at some of the categories of retail sales. This is going to be important. We'll also look at the week before we got CPI. I want to point out a few categories on the CPI, but let's look at the categories for retail sales. I'll show you where to find retail sales. It's got 12 different categories you can look at depending on what industries that you're interested in. Once we're done that, let's look at Target and Walmart and what they said, and let's see if it lines up with what we see on the CPI and what we see in retail sales. Let's start with the CPI report. This is from Table 2, and if you scroll down in Table 2, I've got some items highlighted. Let's get down to all items, less food and energy. We saw that was up 0.6 month over month. But let's look for where the negative signs happen to be, and they cluster down here. Notice appliances, major appliances, laundry equipment, and other appliances. I want you to notice that. Other household equipment and furnishings, these are called hard lines. At least Walmart refers to them and Target refers to them as household hard lines. Clocks, lamps, decorated items, indoor plants, dishes, flatware. Notice that they are all down as well. And come down here, look at apparel. Apparel is down 0.8%, and it's mixed in some categories, but apparel is down. I already pointed out last week, new vehicles up 1.1, but they switched their methodology in counting. And here we have used cars and trucks down 0.4. Keep this in mind, apparel, household hard lines, which are these categories down here, and appliances. Here is the release for retail sales for release at 8:30 a.m. Tuesday, May 17th. It is put out by census.gov. The link for this is in the description box. And I've highlighted some points that are, I think, important to read. Adjusted for seasonal variation and holiday and trading differences, but not for price changes. What is this means that the report for retail sales is adjusted for certain things, but not for prices. In other words, it's a nominal price. It's not a real price. So they tell you that up front. 677.7 billion, an increase of 0.9% from the previous month, and 8.2% above April 2021. So retail sales for this month were 8.2% higher than a year ago. And you would measure that, as we did on the previous screen, against the appropriate price inflation index. And since retail sales cover gasoline and food, we would use the headline price for the PCE, which was 6.6. And we have positive real growth, or positive real increases in sales. Total sales for February 2022 through April 2022, they're just using a 3-month period here. We're up 10.8% from the same period a year ago. So some extra momentum in the 3-month period from February to April. April over April was 8.2, and this 3-month period is up 10.8. Retail trade sales up 0.7%. Gasoline stations were up 36.9%. And we'll compare that with the price increase in gas. That's pretty much in line from the price increase in gas. This is big. Food services and drinking places were up almost 20% from last year. Why? Why do you think that they were up 20% from last year? Because there is so much demand, or because everything was shut down last year? This is part of the reopening, or the reopened. We're not reopening, we are reopened, is that there will be a shift back to services. In the middle of the pandemic, I think 4 or 5 months into the pandemic, I put a video out called Heavy Reversion to the Mean, when everybody was projecting the change in society that is going to happen because of the pandemic. Office buildings are going to disappear. Everyone's going to work from home. Condos in cities will empty out. Everyone will head to the suburbs. All of these projections. And I said, no, that is not what's going to happen. What we're going to see is a heavy reversion to the mean. That as soon as people are free to do what they used to do, they will go right back at it. Nothing will change. There may be some lingering effects that'll fade over time, but in 3 years, we won't be talking about work at home. It won't be a thing that if somebody says, I want to work from home, they simply won't be hired. It is going to be heavy reversion to the mean. Well, they're open. So what's going on is all of that demand for goods. Okay, we don't need all that stuff anymore. We have this stuff to spend our money on. We're going to go back and buy experiences. We're going to spend money on services. We're going to spend money on this kind of stuff. And that is precisely what Target and Walmart saw in the mix of sales that were going on. So we'll look at them in a few minutes, but let's just keep scrolling down here. I highlighted a few more things. If you keep going down, you'll get to the tables itself. So table 1, this is April, 677.7 billion. The April before was 626 billion. So you can actually calculate the year over year, and you'll find that it is the number that was reported. Then they break it down into the 12 different categories. So if you're interested in the auto manufacturers, they have motor vehicle and parts dealers. There's furniture and home furnishings, whatever you're interested in here. So you can dive deep on this. If we look at motor vehicle and parts dealers, 134.5 billion down to 132.2 billion. This is consistent with what we've seen from the auto manufacturers. Is their sales are lower year over year. They're not because they have a demand problem, but because they just can't make anything more than what they're already making. This is important. Furniture and home furniture, 12,072, 12,173, hardly even moved, like basically flat. Electronics and appliance stores, 8.2 down to 7.8. When you had the stay-at-home, when everybody went home and they had to stay at home and nobody could buy services, everybody had extra money. Well, let's turn our home into an entertainment center. Let's buy as much entertainment in-house as we can. If we can't go out to entertain ourselves, if we can't go to the movies, let's recreate the movie experience in the house. Well, now that you can go back to the movies, look at that. Look at that drop. So this had a lot of inflation, not inflation in terms of price inflation, but inflated sales in here because you're trying to replicate in your home what you can't go out to get. As soon as you can go out to get it, there you go. Building materials, garden and supply dealers, 41 to 42. Just a small bit of growth on that one. Food and beverage stores, 71 to 77. Nice jump there. Gasoline stations, look at this, 45 billion to 62 billion. So that is 17 billion year over year that got taken away from other categories. Food and service, this is drinking places. This is going out 69.9 all the way to 83. All the way up to 83. So think about that increase. You got about a $14 billion increase over here that also had to come from goods over here. We're starting to put Target and Walmart in a little bit more perspective. And yeah, there's some other charts that you can go through as well. But the link is in the description box if you want to dive deeper into certain categories. Maybe you're into some of the retail clothing stores and looking at how they're doing over time. There it is for you. Before we jump right into the conference calls for Target and Walmart. And we're not going to listen to them. I've listened to the conference calls, and I've taken down, and I'm going to report to you on the screen what the highlights are. Let's just look at what has happened over the last few years. If we go back 2016, 17, 18, 19, you had growth in retail sales that looked like this, and it would have continued probably to grow. But then you had a pandemic hit, and it shifted demand from services to goods, and you had this ramp up and change in direction and change in growth rate of the demand for goods. And when that happened, you had rapid stockouts. You couldn't get anything. So companies started ordering, not only just to replenish the inventory that they lost, but they increased the amount of orders to account for this particular trajectory. But you had supply bottlenecks because other parts of the world were shut down as well. The supply chain wasn't working that well. And you also, depending on what you were ordering, were coming up against limited capacity. So you had sort of a plateauing here. And then you had the reopening happening along here, and a shift back to services. Goods demand started to drop. You had imports show up in Q1 of 2021. All of these orders back here, all these replenishment and increased orders started working their way through the system and started showing up in Q1 of 2022. And if we look at Q1 GDP, we saw that imports brought GDP negative. If it wasn't for imports, we had positive GDP. It brought it negative. Well, Amazon said, we think we built too much. Target, we had an inventory glut. Walmart, we were way overstocked on inventory. All of them overstocked because all of it started to land right at the time when the consumer was shifting back to services. So you didn't have this kind of trajectory going on anymore. You didn't even have this kind of trajectory going on anymore. You dropped right back to this, right? Well, what's going to happen is orders are still going to be arriving because they were already made. So through Q2, you're still going to have orders arriving and you're going to have an inventory problem. Consistent with what Target and Walmart both said. You'll get a big glut in inventory that has to be worked off. Q3, you will have price cutting to get that done. Now, I want you to remember those categories we saw on CPI, they were negative. We're going to see what Walmart and Target said they had to do and in what categories they did them in. This is deflationary. This is deflationary. And then, so whenever you get a pattern that looks like this and you get a shock which does this, you're going to get this kind of thing before it settles out again. You're going to get these swings both ways before it settles out again. You had the overshoot this way, you had ordering to build up, and then you have the undershoot going on right here. Now you may think, well, couldn't companies see this happening? Couldn't they have forecasted that? They're so good at what they do. They've got so much data. Don't you think they would have known that? Well, companies they didn't really have a good choice to make. It was one of two things. Order based on 2 years of elevated goods demand and have inventory on hand, or face stockouts. Which one is it going to be? Are they really going to shift back to services? Are there going to be more shutdowns? Is this over? Is it done with? Are we going to remove all the COVID restrictions? If we are, we shouldn't order this. But what if they don't do that? Then we're going to have stockouts. And if we have stockouts, we're going to underperform our peers. We're not going to be able to have anything to sell. Well, then it's better to order and have to liquidate our inventory than to not have anything and sell. There really wasn't a good choice here. It's you're between a rock and a hard place, right? So Target was overstocked on what they called the bulky inventory: appliances, TVs, patio furniture. Notice appliances. Notice this home electronics, right? Those two categories were negative that we saw in retail sales going back from 2021, April 2021 to April of 2022. These were the ones that were negative. Patio furniture. Plus they had a rapid slowdown. They said, we also noticed a rapid slowdown in apparel and home hard lines. Remember I said these are called home hard lines. They were all negative as well. I also pointed out apparel, right? Walmart. Appliances, patio furniture, and landscaping items. Look at that. Appliances, patio furniture, appliances, patio furniture. Ordered way too much of it. Well, it makes sense, right? The patio furniture, if you got to stay at home, let's turn our house into an entertainment place. Well, we need more exciting patio furniture in the back. If we're going to live in the backyard, let's furnish the backyard. So they ordered because their inventories were brought down to zero. They had a bunch of stockouts. They had to replenish inventory plus order more for the increase in demand that they forecasted that quickly went away when they could go back into the restaurants and the clubs and do that kind of thing. So to clear out this inventory, both used inventory markdowns. Inventory markdowns are deflationary. And what did we see on the last retail sales? We saw that sales year over year in those categories were down, and the CPI showed negative signs in front of those categories as well. And as Target and Walmart tell us, they're not done. They are not done yet. This is going to take till Q3 to Q4 to work its way through the system. So there's going to be more markdowns coming as well. And there's another company that also is backing this argument. I'll introduce it to you on the next screen. Okay, let's look at the highlights from Target's conference call. And it is available on their site under Investor Relations if you are interested in it. I do recommend listening to their conference calls because they do present their quarter, and then it's followed by analyst Q&A, and the analysts have good questions. And they get a chance to push management a little for more clarity on certain points. Revenues quarter over quarter up 3.3%. Year over year 23%. Same quarter year over year up 23%. That's incredible. Traffic quarter over quarter up 3.9%, up 17% year over year, which again is pretty good. This does not sound like a consumer pulling back. This is consistent with what we saw with retail sales, is that it is outpacing the price increase based on what consumers are buying. Q1 EPS is up 40% over the same period in 2019. So they just skipped right over the pandemic, said, look, let's go pre-pandemic and just put things in perspective here. Sure, our EPS this quarter took a hit, and we'll explain why it took a hit down here. But if you put it in perspective over 2019, that's a nice 3-year growth rate in Q1 EPS. They saw a big shift from goods to services. And you're probably thinking, well, how can they tell a shift from goods to services? Services sometimes happen with the purchase of something. So you know that there is more recreation or entertainment that the consumer is enjoying if you see sales of sunscreen go up, or sales of products that would be associated with some outdoor event or some entertainment event going up, which is what they saw, and less hard lines being purchased. Hard lines meaning picture frames, candlesticks, things like that, right? Gross margins down 4.3%. That was where their big hit came from. Came from two things: $1 billion in incremental freight costs, fuel and shipping rates, and too much inventory. So they had increased working capital costs. And they say that this will impact, the inventory issue is going to impact Q2 gross margins and improving into year end. So it is going to take a couple of quarters to work this off because they were overstocked, too much inventory came in, but more is on the way. More is on the way, and the shift back to services happened, so they know that they've over-ordered the goods. They know that. They know that there's going to be markdowns into Q2 and Q3, improving into year end. They see no improvement in global supply chains until 2023. Walmart. Revenue year over year up 3.2%. It would have been up 6.9% if you had left the divestiture, and Walmart International had a divestiture that would have resulted, or did result in $5 billion less in revenue year over year. So to make this comparable year over year, just add the $5 billion back on, it would have been up almost 7%. Look at this, they had a 32% increase in inventory. One of the most efficient retailers on the planet in terms of its supply chain had a 32% increase in inventory because their choices were order for the past 2 years of the shift in demand to goods, or risk a stock out. What if there's another shutdown? Then you had, during the pandemic, you had Walmart pickup. You could order at Walmart and just drive by and pick it up. Gross margins down 89 basis points year over year. And they used markdowns in Q1 to clear inventory, and that's where you got the hit to gross margins, because they were clearing their inventory. You're not going to maintain your margins with markdowns, right? You got to clear this off. Also, they noticed their wages expense, they were overstaffed, which is the same thing Amazon said. We expanded our warehouse distribution centers too much. We went a little too far. And with the shift back to services from goods, they're saying, well, we misjudged on this one, and they were overstaffed as well. Walmart's overstaffed, but they didn't lay anybody off. They said just through attrition that they'll get right-sized again. They saw a mix away from discretionary goods, which is what Target is saying up here. They saw a shift away from discretionary goods as well. EPS down 20% year over year. They not only just the excess inventory, the markdowns, and the overstaffing, but they also had supply distribution costs. Container shipping was expensive. We'll look on the next screen at where container shipping rates are now. Cost for storage. If you got 32% more in inventory and you're the most efficient company in the world, you probably didn't have room for that 32% in inventory in any of your warehouses, because they were probably sized just right. And fuel as well. Overstock.com was on Bloomberg the other day. The CEO was on Bloomberg, and he was being interviewed, and he said all his suppliers are, and these are his words, awash in inventory. They are awash in inventory, because when you have that big demand swing to the upside, all the orders go up, but then this is eventually going to happen. Well, then, suppliers can't keep pace. They can't keep pace. Suddenly they start delivering. And that's where you get this. They are awash in inventory. This part is inflationary, because you have stockouts, you can't order it, you get what you want. There are supply bottlenecks all over the place, so as soon as it hits the shelf, it's gone. There are no markdowns at all. This is deflationary, and this is where we are here. So I think going forward, all of the data is pointing towards a dropping of inflation quite significantly over the next couple of quarters. When you combine the CPI data with the retail sales data, you look at what categories that you had price declines on, you look at what Target and Walmart did, you listen to what they have to say, this shift back to services, both of them mention that. The mix of what they're selling away from discretionary goods. They're both citing the same problem with supply. They're both citing the same problem with inventory. And it matches with Q1 GDP when we look at the import amount, and we see this huge hit to GDP, this big negative. I think it was like 250 basis points. It was over 2%. Drop in Q1 GDP that imports cost us alone, because everything started landing all at the same time. This is going to do a lot to fix the problem we're in. I don't think that all of this talk of rising rates at 3%, 3.5%, I don't think that's going to be necessary. I think we're going to see inflation dropping and easing at a faster rate than we think. And I do firmly believe, that the inflation that we're seeing is purely a result of supply bottlenecks all over the world, and that we have this period of inflation, supply-driven inflation, that once it's gone, we are going to get back to the problem we had before, which is the threat of deflation. So rates, I think, maybe by this time next year, will be headed downwards. And I think if you go out 3 or 4 years, we'll probably be back at the zero line because of deflation. So we're seeing from Target and Walmart that they're saying the inventory problem is going to take a couple of quarters to play out. But they also had a hit to their margins from transportation costs, both fuel and shipping. So for shipping, the transportation cost that they're most affected by is the container cost. So we'll look at FBX. I introduced you to these two indexes. This is the Baltic Dry Index, This is the Freightos Baltic Index for global container freight. The Baltic Dry Index is for bulk carriers for raw materials, iron ore, coal, grains. So let's look at what happened here. April 15th, it was at 92.32. As of May 20th, we are at 84.66. So we can see that it is still coming down. So that is heading in the right direction for both Target and Walmart. They also said they were hit with fuel costs. If we look at January, the beginning of the year, January 1st to the end of the first quarter, which is March 31st, RBOB, which is wholesale gasoline, went from 233 to 309, an increase of 32.63% for Q1. If we go from April 1st to May 20th, just into Q2 where we are now, it's up another 24%. This is Q2 to date. So you've got a 65% increase year to date. Not year to date, year to date. Come on, man. Let's put a D in there, not a B. This is diesel, up 56% year to date. So this is not heading in the right direction, although they may have already incorporated higher fuel costs into their pricing. We still have the inventory to work off. The freight rates are coming down, so that's improving. However, the fuel charges are not going in the right direction for either of them. I should mention with Target, they also did announce on that call that they do plan to increase their dividend 20% by the end of the year. So they are looking at a dividend increase, and they have a $2.7 billion stock buyback, which they think they'll complete by June 1st. To put that in perspective, they had a $7 billion stock buyback last year. So the stock buyback is lower. They are going to increase their dividend, but they increased their dividend by more last year. So Target is one of, and same with Walmart. These are a couple of stores. They're not going away. Their revenues are up, which is the important thing, is that they are selling more. They messed up. They projected out a continued strong demand in certain goods sectors that did not play out. They did not anticipate the rapid shift back to services from goods, and they probably misjudged the speed at which everything would have opened up. If you recall, at the beginning of the year, there was just pressure on almost every government everywhere to just scrap all mandates altogether, and many of them did. Contrary to what a lot of the medical professionals said at the time, don't do it, don't do it, don't do it. They just did it because of the political pressure. You just couldn't keep people back anymore, and as soon as they could get back at it, they went back at it, right into services. So the takeaway from this is that the Target and the Walmart story is not so much a consumer story on the strength of the consumer, as much as it is a company-specific story. They messed up. Same with Amazon. They messed up. They projected out a demand in a category that didn't materialize. They misjudged the speed at which the consumer was absolutely willing to embrace the old lifestyle they had in terms of the mix between goods and services. It's company specific or retailer specific. But it's not consumer related. I would not look at these two companies and say, aha, the consumer is dead. They're not dead. They're not dead. Food and beverage outside the house up 20% year over year. Does that sound like a dead consumer to you? They're not dead. They're just not interested in stuff anymore. They're interested in experiences because they lacked it for so long. With that in mind, and with the housing backdrop in mind in terms of the risk of higher rates being the enemy right now on a fight that higher rates simply cannot win. Higher rates aren't going to do anything about food prices. Higher rates aren't going to do anything about gas prices. Higher rates aren't going to do anything about home prices. What is going to do something about inflation is Target and Walmart overstock. Having to clear things out. Is the system working on its own? Is the balance happening on its own? That's going to happen without any rise in rates. We're seeing rises in rates, and we're not seeing a consumer that is slowing down. Let's look at index valuation metrics. We basically have Q1 behind us for the S&P. 474 have reported. There are a few more. I think there's 16 this coming week that are reporting, but it's in basically. Q1 earnings up 11.1%, given what has reported so far, excluding energy up 5%. Now, mind you, that's low, but not as low as what the projections were at the beginning of the year. That came in better than what they were at the beginning of the year. Revenues up 13.8%, excluding energy up 10.5%. So again, think about the PCE, because that's what you would use. You would use the PCE for this, because inflation, CPI will measure a price change. But if something didn't sell, it could not have shown up in revenues. So that's why you would use the PCE. 6.6% headline, and revenues, including energy, up 13.8%. This is not a consumer that is concerned about things. Here is the beginning of the year. This was earnings revisions, and all quarter went down. No, companies aren't going to do it. Nope. All things are getting bad. Things are getting bad. Here's the invasion of where are we? February. There's the invasion in here. Things are getting bad. Things are getting bad, and they start reporting. Oh, and more report. Oh, and then even more report. Wow, and then the fewer and fewer report, and up we go, to the point where what actually happened was higher than the forecasts were at the beginning of the year, and all of the pessimism was reversed basically by the end of the second week of earnings. Was reversed, and then up we went. So I say that because there is a growing chorus of analysts saying we need to see downward revisions to earnings. We need to see downward revisions. Well, all through Q1, the market went straight down. Why? Inflation, the invasion of Ukraine, gas prices soaring, food prices soaring, all of this soaring. Oh, earnings estimates are going to have to come down. They're going to have to come down, and down and down and down they came until it was time to report. And then it was, we kind of missed that, right? Let's look at we've got the 500, the 400, the 600, and the Russell 2000, the last close. I only picked on the S&P 500. We don't really talk about the 4, the 6, or the 2, or the Russell 2000. I just follow one index here. This was 3,900.79, and I've said before they use the opening on Friday because they publish during the day sometimes, so they don't have the closing number. Well, the closing was 3901.36, basically unchanged on the day. Considering that Friday was a really wild ride. We were down, and it looked like we were going to keep going. It went into bear market territory, and then kind of like in the snap of a finger, everything turned around and went right up the right side of the chart, and it turned green into the end of the day. Just a bit of green. Trailing EPS, trailing PE, forward EPS. This is the estimate so far, 235.22 per share. Forward PE of 16.6. And I have heard analysts talking about, well, these have to come down. The last shoe to drop are all of the earnings revisions coming down on the companies. And you know, over the month that companies were reporting, we had bad news. Markets just kept dropping and dropping and dropping, but companies, look at this chart, straight up. So I said, okay, well, let's just take a number at random here. Let's say that earnings revisions comes in and it drops the forward earnings 10%. So instead of 235.22, it's going to be 211.70. It's even going to be below the trailing 4 quarters. Let's put it down to 211. And let's just put a multiple of 15 on the index instead of 16.6. You get to 31.75 on the index. If you believe the 10% down. I don't, because all of this happened against the backdrop of inflation, higher rates, the Fed talking about higher rates, the Fed really talking about higher rates, the Fed screaming higher rates, and Russia-Ukraine. Gas prices straight up, wheat prices straight up, corn prices straight up, supply channel disruptions, home inventory straight down, car inventory straight down, and this all happened. That all happened. So unless you think that this is all going to happen again at the same magnitude on top of everything, I don't know. I'm not seeing the 10%. I'm not seeing it. If we look at GDP forecasts for the second quarter, and the best forecaster for earnings, the biggest driver for corporate earnings anywhere in the world is GDP growth. Always the biggest driver is GDP growth. Bank of America has their Q2 GDP forecast at 2.6%. This is a real GDP. Oh, that R goes in front of there. This is real GDP. Goldman Sachs, 2.6%. If we use the Atlanta Fed's GDP now, which I introduced to you a while back, 2.4%. And these are recent numbers, and we are 7 weeks, 6.5 weeks into the second quarter now, that we've seen enough data come out that we could modify our GDP estimates. We've seen enough data. We've already seen some reports coming out that if it looked really bad, I think that these would be significantly lower than what they are now. So you do have decent growth in Q2, not off the charts, but decent growth in Q2. You do have evidence that companies can adapt and modify and adjust and still deliver earnings. That when I see this, people talking about, well, these have to come down 10%, I start thinking, I don't know about that. There's a lot of hyperbolic statements in the market. The CIO of Nuveen was on Bloomberg the other day and was talking about why she was negative on retail, and looked at Walmart, said, well, look at Walmart, look at Target. This is showing us that consumers are not going to pay anything for inventory or for goods anymore going forward. And she said it twice, and I thought, they're not going to pay anything for anything anymore going forward? Isn't that a little hyperbolic? All this extreme language? But you see, that's a problem. It's not so much that it's extreme language or hyperbolic. It's part of a narrative. And when a narrative gets a hold of a market, all the data in the world isn't going to save you. If you think the consumer's going to pull back, these have got to come down, you don't think it through anymore. Logic disappears and you replace it with a narrative, because a narrative is easy to talk about. And then you start thinking about stag, and then you see inflation. Stag meaning stagnation, right? Economic stagnation, and we have inflation, so you combine the two and you say stagflation. And when you repeat it enough times, you start to buy into it, you start to believe it, and it is a hard narrative to psychologically break. So before you buy into a narrative, you step back and you say, well, hang on a second. Let's look at all the component parts. Let's look at all the little clues, all the puzzle pieces, and let's put it together and see if that narrative is actually true. Beware of this hyperbolic language. Oh, people don't want to buy homes anymore. Really? They don't want to buy homes anymore. I've heard that statement thrown out. Consumers just don't want to buy homes anymore. Really? Not one. That means the next report we see for home sales should be zero, just zero. Nobody's going to buy a home. But it's part of that narrative that gets it across. It doesn't sound good to say 0.2%, home sales will be down 0.2% year over year, primarily because of a supply constraint. You see a drop and you think, that matches my belief that I'm bearish. People don't want to buy anymore. People aren't going to buy any more goods anymore. CIO of Nuveen. People aren't going to buy homes anymore. They don't want to buy homes at these prices. It's all part of this narrative. Weeks ago, I said I can't make the bear case because I was data driven. I'm looking at the data. I'm looking at what's going on. I'm looking at periods of time in history which kind of look like this, and I don't see the consumer falling off the edge of a cliff. So I don't have a narrative. But once you get a narrative in, it's very, very hard to move away from. And so the bear market case that I could make today is either a policy mistake or this narrative not leaving, this narrative grabbing hold more and more, regardless of what the data are showing. Yes, I know it's a busy screen. but this screen is trying to tell a story that is meant to refute another story. So let me tell you the story that I'm trying to refute. There is this narrative out there that suggests that the gains in the market since the great financial crisis have largely been driven by ultra low interest rates and a huge increase in liquidity, the Fed's balance sheet ballooning, and especially since the pandemic, the rates that were dropped to pretty much 0.2 for a long period of time, and the massive increase in the size of the balance sheet. That without all of that, we would not have had the market we've had for the last 10 years. That all has to reverse. So I thought, well, let's put that into context. Let's look at 10-year periods through history, and let's compare it, the compounded annual growth rate over those 10 years with the average yield on the 10-year Treasury. So I'm calculating 10-year compounded annual growth rates here. And how I get 4.39% for the 60s is I look at the index price on January 1st, the opening price on January 1st, or whatever the first day of trading is for 1960, and then the last day of trading in 1969, December 31st, 1969, and you calculate what a compounded annual growth rate would be over those 10 years. Then you look at the average level of the 10-year Treasury. 5.7% for the 60s, 4.39 compounded annual growth rate in the price index. Okay, that's just the price index. In other words, I'm not considering dividends at all. Dividends would add about another 1.5 to 2% to these numbers. And because I'm not considering dividends, obviously, I'm not considering a total return index, which would be the reinvestment of the dividends themselves. Just to give you an example how powerful that is, when we look at the 2000s, the index over 10 years, you would have lost 2.71%. On the price index only, you have to add about a 1.5 to 2% dividend yield per year over 2 years, plus the reinvestment of those dividends on a total return basis. It was not, contrary to what many people call it, a lost decade for investors. It was not a lost decade. You have to look at it in terms of a total return index. This is just price return. So all of these returns are basically understated. 1960s, 4.39. 1970s, that was pretty ugly on price. 1.6, Treasury yield, 9.13, average Treasury yield. And in the 1980s, the average Treasury yield was still elevated, 9.55. It was only after 1985 did it come slightly lower, 12.59%. Price return over the 80s. And you think, well, okay, that was just the 80s. You're not going to do that again. 15.32% throughout the 90s. This is not the NASDAQ. So .com was primarily in the NASDAQ. This was the S&P 500, not the NASDAQ. 7.28% average yield on the Treasury. And 2000s, you had a lower Treasury yield, negative price return because you had to deal with both the .com crash, which happened over here, and the great financial crisis. If you had offset these 10-year decades like 65, 75, 75 to 85, 85 to 95, the numbers would change, but the pattern would still be the same, except you'd get rid of this negative number. 2010, the 2010s, 11.21%, the average Treasury yield 2.86, and if you consider the full 12-year period from 2010, it's 12.86. So to get a 10-year compounded annual growth rate from 11.21 to 12.86 by adding 2 more years, those last 2 years would have been outsized. And they were. I grant you that. They were. But do we have to reverse the last 10 years? Do we have to say this decade had ultra low interest rates and massive liquidity? You're not going to repeat that again. Really? Look at the 90s. Look at the yields in the 90s. And inflation in the 90s, you get an inflation report at 4.3, 4.4, 4.5%. It was meh. Yeah, meh. You didn't have 0.1%, 1% or 1.6 or 1.7 like you had for quite a few years in here. You didn't have those low inflation rates. You had fairly high inflation rates. You had high treasury yields. You didn't have ultra low rates. You didn't have a massive ballooning of the balance sheet. Look what the economy was able to do in the face of all that. 15.32 price return. The 80s, 12.59 price return. So we honestly can't repeat 11.21. And we're talking about bringing rates. Here's 2.5. We're talking about bringing rates maybe to here. Maybe to here. Look at that. Maybe to here. And no. A market that is got a lot more cash on balance sheets, a lot wider margins, a lot less reliance on cyclical industries, a lot more global than it used to be, and it can't do it. It can't repeat that again. By God, if you get to here, it can't repeat that. And if you take $1 trillion off an already bloated balance sheet to have a somewhat bloated balance sheet, no, can't be done. You're never going to repeat that again. Give me a break. I think, and I've thought this for many, many years, I think the market gives way too much credit to the overnight interest rate to engineer an economy. I don't think it has nearly the effect it has on the real economy. I think it has a lot of effect on the psychology of financial market participants who have been taught that the interest rate can engineer an economy. So we buy and sell and we buy and sell. But drive past them all. Ask anybody in that mall, hey, what did the index finish at this week? I don't know. What's the current interest rate? I don't know. When's the next interest rate meeting? What are retail sales? What's the level of inflation? What's this? What's that? I don't know. All I know is that I'm in the mall and I got paid. I'm going to go buy stuff. We see this volatility and we think that the financial decision is primary, that it is the decision that we're making. But consumers don't make financial decisions. They make lifestyle decisions. If you study consumer behavior, the first decision they make is a lifestyle decision. The second decision they make is how to finance it. They've already made this decision. I'm going to buy this house. How am I going to finance it? I'm going to buy this car. How am I going to finance it? 5 years is too much. How about a 7-year loan? How about a lease? How about this? How about that? The interest rate doesn't really get in our way very much. All it does is it just changes how we would finance the lifestyle choice we made. I want a house. Well, how are we going to finance it? Well, I don't need all the upgrades and I can use a smaller footprint. I'll just have a smaller house built, but I want a house. I make my lifestyle choice first. I make my financial decision second. Yet in the market, we believe that the financial decision is primary. But this is not shown out in the data. It's not shown out at all. In fact, it almost seems as if you have a bunch of smart people in a room thinking that they can engineer an economy when actually they can't. All they can engineer is the effect on the market. And then we think it has some kind of effect. Meanwhile, the average person on the street has no idea what's going on and is spending money. So let's look at a interesting trade on the SPY. We're at 390.62 right now. And just to finish up the thought I had on the previous screen saying, like there's a distinct difference between the real economy and the financial economy. And we see the financial economy and we think we extrapolate that to the real economy. Whereas for 85-90% of the people out there, they have no idea what's going on in the financial economy. They are the real economy. And to repeat what we saw earlier is January 1st, estimates for earnings went like this until earnings started to be reported. This is the financial economy affecting our perception of what's going on in the real economy. Then earnings start, there's the real economy. Right, the real economy will show up. We're just looking at it through glasses that are warped, I believe. Anyways, 390.62 on the index. Look at the. We're going to set up a $0 risk reversal on this one here, and look at the asymmetry we can get. $400 call with a 373 put. The call is $9.38 out of the money. You can get a put that is 1762 out of the money. That's not symmetrical. That is extremely asymmetrical. Because we have elevated skew on the index, you can go deeper out of the money. You can get a delta of 0.658, and this has a lot of convexity in it. It's going to require margin, $6,050 US in margin. If you're in the US, it's only, the margin is based on a 20% amount of the price minus what's out of the money. If you're in Canada, it's 30%. It's going to cost you closer to 9,500 US margin to get that done. You don't have to put this all on at one time. If you are, if you had taken the options course that I have, you know that we can step into this, and it gives you flexibility in what you can do after. You can either step into a risk reversal or step into a bull spread, or simply take profit. So you can step in, buy the call on day one. You're going to spend $638. If the index goes up, you already have a gain. If the index goes down, you can move more out of the money on the put to get a zero cost. So right now the 373 put is 638. If you buy the call and the market drops, you can go deeper than 373 to find a put for 638, because all you have to do is cover off the cost, right? Not only that, if the market drops, the skew will increase even more. So the change in the out of the money that you can get will be greater than the change in the drop in the index, meaning that if the SPY drops $9, you could probably get $12 to $13 deeper out of the money. How far out of the money you can go will be greater than the amount that the index drops if the skew increases as well. So you get a really, really asymmetrical risk profile on that one. If the market goes up, you can take your gain, or you can step into a bull spread in a number of ways. And you have whatever the 400 would be your X1, whatever you set up for X2 would be your theta gain. So you can still have a delta gain along with a theta gain because you're selling the upside call. And you have two levels of resistance here. You have 40.50, which would be your first one. You could sell a call at 40.50 on any rally, or if you feeling really good, you can wait and sell the 41.50. You're targeting a delta anywhere from 0.15 to 0.3 on the second call. The closer you get to 0.3, the closer you'll get to a zero cost bull spread, which means it costs you nothing for the bull spread. Now, I've heard this referred to many times as a risk-free trade, that once you put on the second leg of the bull spread and you have your bull spread for free, that you have a risk-free trade. No, you don't. You have a loss-free trade, but not risk-free. Means if you can set up the second call on the bull spread, that you're selling the second call for what you paid for the first call, you can't lose. You cannot lose. And you're probably thinking, yeah, but that's risk-free if I can't lose. No, because you're risking the gain you already have. By setting that up, you're risking the gain you already have. You're hoping that it continues on, or that your second option was a theta play and that the market would not retrace the gains that it made. If you think it's going to retrace the gains that it made, take your gain. You can either set up the risk reversal now. It's got a nice asymmetry to it, or you can take on one leg and determine whether or not you're going to take a gain, step into a bull spread with a theta play, or whether you're going to get deeper out of the money on the put to finance that call. This is for the June 17th expiration. Keep in mind, you have the Fed meeting on June 15th. And we are May 23rd. Monday, May 23rd would be the first day trading. We're on the weekend right now. So May 23rd to June 17th, you would have to believe that we're in oversold condition and that we can rally. If you believe what I believe, which is that that if we think about financial conditions and that affects our decision about the economy, but that the real economy operates in behind, you would like to at least get Q2 earnings behind you, because the real economy isn't going to show up in the next couple of weeks, other than in reports, whether it be for durable goods. We have that coming up this week, the PCE, things like that. We get some glimpse of the real economy. But if you have a narrative, that data will be ignored. That data, it's hard to punch through a negative narrative, even with data that says, I don't think your narrative is exactly right. If this doesn't work out, what happens? You have to be willing to accept the market at 373. That at 373 you'd be a buyer of the market anyways. And if you were going to be a buyer of the market at 373 anyways, this risk reversal makes a lot of sense. If you don't want to be a buyer of the market at 373, then you might want to just limit yourself to the call. If it does drop, well, this has convexity. It's not going to drop at the same rate that the market drops. And if it does rise, you have a gain, or you can step into that bull spread. Canadian dollar. What the hell is wrong with the Canadian dollar? And by the way, I'm not the only one asking that. David Rosenberg in the Globe and Mail, if you're in Canada, that's a very big name in the markets, at least as far as an economist is concerned. Very widely followed. The Globe and Mail had a story. Canadian dollar is seriously undervalued, and this was as of May 15th, which I believe as well. His target is 83 cents on the Canadian dollar. That 1 Canadian dollar buys 83 cents US, or said another way, that 1 US dollar would buy $1.20 Canadian. So this is $1.20 down here. This is his target, meaning this is the value of the US dollar, sorry, the value of the Canadian dollar in US dollar terms. And the trend has been downward, that the US dollar was depreciating against the Canadian, or the Canadian has been appreciating against the US. We have resistance right around 130. We've been there once, twice, and here we are again. Once, twice, three times a dollar. Isn't that a song? Once, twice, three times a dollar. I think so. And then you have rising support each time, which, you know, for a consolidation pattern, it would look better if it were the other way, if you had something that looked like this, but we don't. We have an upward sloping pennant flag formation on a downward trend, which you can call it consolidation, but it's not a strong consolidation as you'd like to see. So first target on any long position or any short position on this, if you're playing the pair, first target would be just under 126, 125.5, which is kind of where we were last time. And if we can get past that, you've got 120 as the target, which we did see last time. Two ways to do this. You can sell spot, but spot creates a bit of a problem if you don't know how to manage your currency positions. It creates a US dollar liability, and that is going to cost you interest. It is going to cost you a US interest rate. However, depending on what you do with your Canadian balance, you may not be able to offset that with a Canadian interest income. So selling spot is not really the best way to do it. You can use long Canadian futures. The payoff is in US dollars. And the interest rate on CAD is very close to the interest rate on the US. So if you know how to price out a forward contract on a currency, you would know that that would be trading neither for a premium nor a discount, but pretty much at par. It is a slight discount right now, which is good, because if you're trading currencies, you want to buy discounts and sell premiums. It is a slight discount, 12 pips, not much. So the futures, the July futures is 77.70 versus 77.89, and the target from Rosenberg is 83, which corresponds to $1.20 in, using the 1 US dollar equaling 1 Canadian dollar. This is 1 Canadian dollar equaling 83 cents US. This is going to require margin, 29.30 US per contract. The underlying is for 100,000 Canadian, which is basically, at this rate, the underlying is 77,700 US dollars. Now the interest rate is in here, so you are paying the US interest rate. You're paying the US interest rate here, but you're paying it here. However, you are implicitly within the futures contract receiving the Canadian interest rate. You would not be receiving it here unless you took the Canadian and you actually bought something with it, whether it be a 30-day Canadian bill, whatever the case is, you would have to do something. The one other problem is the U.S. liability that you have is going to be the broker rate of interest on your U.S. dollar and not the bank rate of interest. It's not going to be the spot rate of interest. It's going to be the banker's rate of interest, which you're not going to get offset with the Canadian. So spot trading is really for, I mean, if you're spot trading, it's either you're new to currencies and you don't know what you're doing, or 100,000 is just too big for you. But it's not the most effective or the best way to take advantage of any kind of currency trade. Spot trading is kind of like, you know, the lowest form of currency trading, only because it has that huge cost associated with the negative currency balance on the other side, the negative US you would have to be long the CAD, and the dissimilarity in the interest rates. Here it's all wrapped up in the futures contract. So the idea that you're not paying the U.S. interest rate, you are paying the U.S. interest rate, but you are implicitly getting the Canadian rate and you're getting bank rates. And right now they're very, very close together, and it gives you that 12 pip premium. Not much. It amounts to about $120 in automatic gain. You have a $120 embedded gain in here based on where the spot price is. It's not much. It's not a big deal. But hey, it's there, right? So I've been an advocate of a long position in the Canadian dollar for some time because I just don't understand the Canadian weakness. You know, I look at other currencies that are moving and I think, you know, this one's stronger against the US and this one's stronger. What is wrong with us? Why are we getting no respect? It is one of those puzzles. I've been talking about it for a while now. I think 5-6 updates ago I said it's a puzzle. I can't figure out why the Canadian is not stronger. And this person, 5 days ago, this person who knows a lot more than me, by the way, a lot more than me, also has the same problem. This is the headline. If you search for it, Globe and Mail, type in this. These were the actual words: seriously undervalued. Getting an economist to say something that extreme, there must be something there. Anyways, if you are interested in a currency pair, I think as a U.S. investor, being that the Canadian dollar is so weak right now against the U.S. that you could buy Canadian equities at such a low price right now. And Canadian apartment REITs have taken a beating for no reason. That if you wanted to get a double return, I think buying some of the Canadian apartment REITs with your U.S. dollar and not hedging, the Canadian dollar will increase over time. I think along with the price of the share. The one that I am most bullish on is CAR.UN, which is CAPREIT, the one I'm most bullish on. So you get a double return, the increase in the currency and the increase in the underlying. If you agree with me, you may say, no, the US dollar is about to enter king dollar territory. Things are about to get a lot worse, and the Canadian is just going to sink only because money's going to flow to the US anyways. You may believe that. And if that's the case, then I will be wrong. You may be looking at this and saying, buddy, you got a triple top, and you're hanging out at the triple top. That is dangerous. This is not a very good consolidation pattern. I agree with you there, by the way. It's not a very good consolidation pattern at all, because it seems like I don't want to see this kind of trend going on a consolidation pattern formed from a downward trend. This looks more like a reversal than a consolidation right now. But you may be saying, no, you're wrong. You and this Rosenberg fella, you're wrong. Okay, oil. Still a big story out there. Every top of the week it seems to sell off, and then it seems to rally at the end of the week, and there we are. And it seems to be picked up at every time it sells off, it's picked up at higher and higher lows. So it's looking more and more bullish. It's had a couple of false breakouts so far. So we're going to set up something here, a bull spread with calls. No downside risk beyond the initial cost, being that there is, the pricing of gasoline is so high right now. I can't see how it does not affect consumer behavior in terms of when they decide to drive. It has to be. So, if there is demand destruction here, I don't know that you will get that much on the upside. I don't know that prices will drop, but I don't know that prices will increase. And prices could drop. You don't know. So for a trade like this is nothing I would do, but if I were interested in playing oil, I would be interested in just grabbing one side of the distribution without any exposure to the other side of the distribution. So I don't mind getting exposure to the up part of the distribution, but I don't want any exposure to the downside. We have a pattern. We had an upward trend, and this is a consolidation pattern, a fairly decent consolidation pattern, because you do have an upward sloping support line and you have a resistance line that's becoming flatter and flatter. Instead of the pennant, you have a right flag formation. This was the first line, and we did have a false breakout over here. From number one, this first trend line was broken with a false breakout, which is this part right here. The second trend line over here had a false breakout as well, and now we're at trend line number 3 in terms of where it breaks. But it's broken out once and then come back right back in. It's broken out again and then come right back in. So it doesn't seem to want to make up its mind very much. Once you get to 113, 114, 115, it just goes and then just runs back 107, 106, and then runs right back up again. If we look at this is July, because you want to capture the busy driving season. 82.85, $3 spread cost $1.30. 82s to 90, an $8 spread costs $2.85. So you pay $130. That's all you pay. There's no margin for this because it is a spread. Once you pay the 130, that's it. And if it does go through both levels, it pays 300. This you pay 285 for, pays 800 for July if it does break out and go higher. This is oil though, which is not the same as gasoline. So sitting between oil and gasoline are refiners, and there's refining capacity constraint as well, which means the tightness in the gasoline market is even tighter. So if you think, well, I think gasoline prices are going up, and you can have gasoline prices going up without oil prices going up. So instead of the USO, you can play the UGA, where the underlying are RBOB. It's an RBOB ETF, so it's gasoline. Gasoline futures. The 70 to 75 spread is $1.70. It's $170 for a $5 spread. This is $130 for a $3 spread, $170 for a $5 spread, or $280 for a $10 spread, versus here you're paying $285 for an $8 spread. $280 for an $8 spread. These are the July contracts as well. Let's just have a look at the IEA inventory levels for both oil, crude oil, and for gasoline compared to its 5-year average. Okay, this link is in the description box below. This Week in Petroleum, the release date May 18th. Next release date is May 25th. There's tabs across here that you can click on. This is just a general analysis, a high-level analysis. We can click on crude oil, and it gives you the price of the contract, contract 1, contract 2. Contract 1 is your front month, and you have 4 contracts here that you can look at. Here is inventory, crude oil stocks. This is the range in here is the 5-year average. We should be increasing going into the summer, and we are well below the 5-year average on oil. And you can click on days of supply, for example. Here we are way down here. This was last year at this time, a little over 32 days of supply. Here we're sitting around just a little over 26 days of supply. So there are different tabs you can click on there. Let's go down and find, actually let's go up here. Let's look at gasoline now. When we look at gasoline inventories, it's even more shocking. So let's find the inventory chart. Look at that. It's not even going sideways. It's just diving straight down. And we should be somewhere in this range. In fact, if it were a balanced market, you'd be somewhere in the middle of this range, somewhere in the middle of the 5-year average. You would then say, it's neither oversupplied nor undersupplied. But look at where we are, and we're going into the busy driving season. So if you are bullish on gasoline and you don't want to play it with a proxy using oil, you can actually play gasoline either with RBOB futures, RBOB, super expensive and they can be dangerous, or you could just use the ETF, the UGA ETF, days of supply. Here we are here versus last year. We're under last year, and it's just been going straight down, just around 25 days of supply. And there are more interesting things here if you want to continue looking more into this. If you're into this kind of stuff, if you're into oil, gasoline, heating oil, even propane, you can look at where we are in terms of propane. It's starting to improve. I don't know if you recall about a month ago or a month and a half ago, if you went to get propane, it used to be about $15 to fill a cylinder, all the way up to $24. It was ridiculous. Well, it's starting to improve. If you're into this kind of stuff, this is a great site and a great resource. We think, and there's some common thinking when I say we, some common thinking that when you get into the commodities, there's just not enough fundamental data because it doesn't have balance sheets. No, but it has production and it has inventory. You can always look at production levels, and you can look at inventory levels, and you can look at the shape of the futures curve. If that futures curve is in backwardation, that means you have a tight spot market. You could look at inventories, and if inventories are super, super low, that price isn't going to change anytime soon because you still are going to have a tight spot market. So there we go. Okay, let's look at our week ahead, see where risk lies. And out of the US, we have 4 big reports, 2 which are really big and 2 which are big but not really big. And we got a couple of big ones out of Canada. We have a holiday in Canada on the 23rd here, Victoria Day. Let's see what we have here. On the 24th out of the US, you have PMI, manufacturing PMI, services PMI. This will give us some read on whether the economy is expanding or contracting. Anything over 50, this is a diffusion index, so anything over 50 is good. If it comes in lower than the forecast 57.9, if it comes in lower than that, then we're still expanding, but at a slower rate than expectations. So we'd like to see both of these increase. New home sales, previous read was negative 8.6%. Let's see where that ends up. Here it's hard to pull apart because even if you have a decrease, you can't automatically blame the consumer. You can't say, aha, higher rates are doing it, because it just could be supply side issues. Let's keep going here. You got a speech here. Powell's the Fed Chair Powell. Mortgage applications, which we always look at, last 11% down. Let's see if that was an anomaly and it recovers. It could have been something about that particular week. Here's a big one right there. Durable goods orders. Last week we had retail sales. This is durable goods. Forecast is for 0.6, and then you have durable goods ex transportation. Your crude oil stock changes. This is every Wednesday at 10:30. You get your inventory levels. It can move markets, especially in a tight spot market. It can move markets, so beware of that. This is the big one here. 2 o'clock, the minutes from the last meeting. In this, we get to see what they talked about. We know what they did, but what did they talk about? Were they more hawkish in that meeting? How many people raised their hands for 75 basis points before it was just discarded? Or was it just a general consensus across that 75 just wasn't a thing? Did they recognize that inflation had moderated a bit? Not a lot, but that the signs were that it was improving slightly. If they have language like that in there, that could be very, very bullish. On the 26th, we get our second look at first quarter GDP. The read was negative 1.4%. But keep in mind, we did break that apart. The consumer was strong. We had negative growth in Q1 because of negative growth in government spending. Good. But all of that inventory hitting the U.S. all at one time, that big onslaught of imports. Well, we already saw Q1. We already saw the first estimate. We get a second and a third look at the same number. It changes. Sometimes it changes, as much as 0.2 or 0.3, but, it does change, but not much. We have the 1.4. It would be nice to see if it came in like 1.3, something a little bit better. But, it's not like it's a brand new number we haven't seen before. It's just adjustments to the first number we had. The first one is called the advanced look, and then we get another look, and then a final look. We get 3 looks at the number as the model tightens up the estimates of what we saw in the first quarter. Pending home sales at 10 o'clock, if you're into the home market. This is the big guy. This is the biggest, baddest guy on the street right now, is the core PCE. This is Friday at 8:30. So we got to live through all the volatility to get to Friday at 8:30. So if you have options, if you have anything going on and you don't want to trade in front of this thing, you're going to want to trade out before that. You can always trade in the market before 8:30 if you have Globex, or if you can trade in pre-market, but you can't trade the options. Look at the forecast. Previous was 5.2. Look at the forecast. 4.9 on PCE. 4.9. We come in at 4.9 or even 4.8. Think of how wonderful that's going to be. That's for core. That is for core. If we're going to adjust the retail sales number we saw earlier, we're going to adjust it by the headline index, the 6.6, well, whatever it comes in at, because retail sales includes food and energy prices. So you would deflate it with the headline number, but the Fed pays attention to the core number. Think about that. If that came in at 4.8, 4.7, think about the reaction in the market that Friday. But if that came in at like 5.9, and it could get pretty bad. Then we have consumer sentiment, Michigan consumer sentiment, still at 59.1. 59.1 is considered, well, quite low, but it's still 59.1. Expected to come in lower than previous, which was lower. We can look at click this open. You get a series of what's been going on with consumer confidence straight down. Now there is some thinking that consumer confidence, if it's low, it shows that they are less willing to make big ticket purchases. That's all. Big ticket purchases. So we will get a little peek at the possibility of that with durable goods orders. You'll get some peek at it. If durable goods orders comes in strong, well then we can expect that consumer confidence hasn't been hit that much. Now, this does not mean, if you have low consumer confidence, it does not mean the consumer is unwilling to spend. It just means they're unwilling to commit to a long-term purchase. That's all that means. And usually it's big ticket items, what they call durable goods, is that they're unwilling to commit to these long-term purchases for durable goods. But it's not like they don't want to spend. 70, even I'd go as high as even say 80% of consumers spend pretty much every penny they make. Now, look at this drop in consumer confidence. This is from June, July, August, September, October. It's just been going straight downhill. Now, it's Saturday. As I'm doing this, drive past any mall and see if you can get a parking spot even close to the mall. Does the mall, if you want to measure consumer confidence, don't ask them what they're doing. Just look at how many cars are parked in the mall parking lot. Go to any strip mall, any mall, and look at the cars that are parked in the parking lot. They drove there, which means they're comfortable with the gas price. They're at the mall spending money, which means gas price didn't take all their money away. The number of people in the mall is consumer confidence. Not calling them on the phone saying, how do you feel? Well, I feel like crap, right? How do you feel about gas prices? Not good. How do you feel about inflation? Not good at all. We're going to hell in a handbasket fast. Now, are we done here? Because I've got to get to the mall. That's the consumer. If you want to measure consumer confidence, go sit in the mall and count the number of shopping bags walking around. People coming out of the stores with shopping bags. That's consumer confidence. So, you can take these surveys with a grain of salt. I wonder, by the way, if anybody is familiar with any academic research or any research at all that shows a time series of consumer confidence with retail sales, showing that there is any kind of predictability on retail sales with the level of consumer confidence. I have not seen anything like that, but I can just imagine that somebody somewhere must have done that. There must be something. And it can't just be a time series of consumer confidence and retail sales. It has to be a whole bunch of other things that can explain retail sales as well. And once you do that, then you can see whether or not consumer confidence has any significance on its coefficient in the presence of other explanatory variables. I don't know. I haven't come across anything like that. But if anyone has any kind of research at all that shows some kind of relationship, some explanatory power of consumer confidence in the presence of other variables to explain retail sales, I'd like to see it. And I'd also like to see what the explanatory power of that one is. I don't think it's that big. Much like the interest rate, I don't think it's the thing. That if you had a regression where one variable was the interest rate, another one was the real output of the economy, but you also controlled for other variables as well: the level of regulation, the population growth, the level of immigration, something that would measure the, some entrepreneurship index, things like that. I don't know that the interest rate would have any explanatory power in the face of other variables that are far more important than the interest rate, because I see people buying homes. In the history, we've seen people buy homes when mortgage rates are 7%, 8%, 3%, 2%, 5%. It doesn't seem to slow anybody down. Anyways, there we are for the week.